What's going on, y'all? And happy Monday, and welcome to another edition of Weeds Weekly. And wow, do we have a ton to discuss. As always, each and every week, I bring to you what happened this past week. We're going to talk about what economic data can impact the real estate market as well as interest rates this week. We're also going to be talking about the rate reduction era is here, right? We've been waiting for it now for about well over a year and a half to 2 years. And it's going to be last week was the first rate reduction in 4 years for the Fed. And then lastly, we're going to talk about let's date. And we're going to dive into exactly what that means. Because the whole idea and the whole objective for me doing these is to educate all of us in this space so we can be better professionals for our clients. And at the end of the day, we can move more properties. So let's just dive in. And wow, what do we have? We had a great week last week. As anticipated, the Fed did their first rate reduction. But again, let's remember, it does not directly correlate to interest rates. So that's the biggest thing that I like to just clear right up front. And the Fed went big, right? No one, I guess towards the beginning of the week, a lot more anticipation was towards a 0.5 point rate cut. Well, I believe a lot of that was politically driven. As you can see from several Fed members, they actually thought that it was a little bit too aggressive with concerns that possibly it could trigger a little bit more consumer spending, which could lead to further inflation. But the good news is this, the greatest news of the week was we are finally in the process of a change Fed policy, which is great for the real estate industry, right? So that is the biggest thing. The other thing that we saw this past week that I thought really played into why interest rates did not have a huge reaction to the announcement and actually saw rates increase towards the end of the week was due to the release of the dot plot, which gives us a great big landscape of where the Fed is thinking the Fed funds rate will be for the remainder of 2024 as we move into 2025 and even into 2026. The other thing I thought was the statements made by the Fed. So let's cover the dot plot really quick. And you'll see an example of it below. There's a picture of it so you can see. But really what it clearly shows is nothing new. Remember, traders in the market are forward thinking. So the dot plot did not tell us anything that traders did not already expect. Therefore, there was basically no reaction. They've already built in where they believe the Fed is going and where they believe interest rates and the Fed funds rate should be today. So that trading has already occurred. So we did not see any major reaction from that. The other thing we saw was Powell continues to have a hawkish stance, meaning that the Fed is still evaluating data consistently. We have not basically cleared the inflation hurdle. The labor market is still a concern, and so on and so forth. So with the Fed and those two dynamics, it played heavily into the fact that traders took that in, realized that the market has already built in the 0.5 point cut and the future cuts for the remainder of this year that are anticipated, which is another 0.5 point. They're then anticipating another full point throughout the year of 2025. And the dot plot also shows us another 0.5% in 2026. And given that the market already knew all of this or perceived that they believed that's where the Fed was going, that is exactly why we did not see any huge reaction. The rates were already at their lowest point. And now that it's been digested, and now that the Fed has clearly indicated they're going to remain hawkish and look at and analyze all that future data, we saw rates increase. So now what do we have for this week? And we have a ton of data coming out this week. You have inflation data coming out with PCE, right? We also have initial jobless claims. We have consumer confidence numbers. We have GDP. There's a plethora of data that's coming out this week. But the biggest thing, will any of it really have a significance? Right? Will any of it really be a big enough mover for us to really be concerned? And my prediction is no. I think the biggest thing we're heading into right now is obviously we're about a month and a half out from the election. I think that's the biggest thing right now from a standpoint of clients and buyers and sellers being on the sidelines and being in quicksand. And what do I anticipate is a lot of this data, it seems like we're getting into a very stabilized environment where we're not seeing the labor market's not falling off a cliff. Inflation continues to recede at an ever so slight level every month, right? And we're also seeing that the consumer is still resilient. Even after all these months of this high inflation and higher energy prices, the consumer continues to be there. The consumer continues to keep the economy afloat. I expect to see good GDP numbers, which I don't think will shock anybody because they're from Q2 and we're already almost done with Q3. So I think that a lot of the data that's going to come out this week is already anticipated. I don't think that anything's going to be shocking, but the couple things that I would really keep my eye on would be that initial jobless claims, because the labor market, again, is the Fed's largest concern, right? So if we see a drastic increase in initial jobless claims, I think that that can move the market. And we have several Fed members speaking this week, and that is something that the traders can digest. They can take that information, those statements, they can dissect them to see if they clearly indicate any change in policy moving forward than what they already anticipate. So those would be the big things. And even Chairman Powell speaks this week once again. So I think those are the main things that can move the market. All right, let's dive into really quick. We are in the rate reduction area and it's finally here. So the biggest thing is now what? Right? Now, what can we expect? And we in the real estate industry, I believe this is an amazing thing, right? We're finally here. We've been dealing with the pandemic, which was absolutely insanity. Things were flying off the shelves. Values were going crazy. Offers were well over asking price. It was frantic. It was unpleasant at times for us and our clients as well. And then we moved into just drastic rate increases. And then we moved to the highest rates that we have seen in well over a decade. So, 2 decades from the early 2000s. So we've had a lot to digest. So finally, given the fact that we are here is an amazing thing. So the big things that we can be anticipate is I believe we're gonna see a lot more activity once we get past this election. And I think we're going to see an increase in volume, right? We're going to see an increase in listings. We have seen stabilization of values at this point. We're going to see more increased activity, and I think we're going to see increased sales. And overall, that is a great thing for the market. However, I do want to paint the picture that not all the time, and history needs to be a great a teacher for us, that this may not be good for everything, right? The reduction in rates is going to be great for housing. We've been the ones that have really been suffering, so that's great news. But things that I want to keep on our radar is number one is recession. So what I say here is right here, the Fed has cut rates since 1996 times. Okay, starting from the point that the Fed began cutting, the economy is falling into recession 18 months later on average. That is something we really want to keep our eye on, right? The Fed has been talking about this soft landing. They've been preaching this soft landing. They are well aware of this, and they really want to avoid this. And the reason that recession typically follows is because the market has moved and the economy has moved in such a drastic direction that the Fed is trying to now once again stabilize against a recession, and they start decreasing rates. But it's something we definitely want to keep an eye on, because should we move into a recession of sorts, it would definitely affect the volume of business and the perception by both buyers and sellers. The other thing is unemployment rate rises, which means that less people have jobs. Another thing we want to keep an eye on, because once again, if you have volatility in the labor market, right, and you have the perception that the employment rate is going higher, a lot of people will sit on the sidelines for fear that they could potentially be the next person to be let go. So therefore, we want to make sure that we keep an eye on that. Once again, I don't think anything of this is concerning at the moment, but now that we're moving into this rate reduction area, we want to look at things that are coming down the pike potentially, so that we can be made aware, so that we can inform our clients, and we can change our business habits reflective of what's going on, so we can stay ahead of the curve. And the last thing is inflation. It's really been a coin toss. Inflation's been one of those ones that sometimes it has spiked consumer activity. They have more purchasing power now. Their credit card payments are going down. Their car payments they'll be able to renegotiate and going down, or if they're purchasing a new car. They're going to be able to refinance their mortgages potentially and decrease and create more monthly cash flow. So on the flip side of that, however, if it does increase that activity, what's going to happen is that's inflationary. You got, once again, more dollars chasing fewer goods, and that could potentially be a problem. So we want to make sure we keep an eye on that as well, because the last thing we want is that dot plot to change, and now all of a sudden we go from a stabilization where the Fed does not want to do anything, does not want to act, does not want to decrease those rates, and once again possibly has to consider increasing interest rates to once again curb inflation. And the last thing I wanted to discuss is let's date, right? And dating is always a wonderful thing. It's always a fun thing, right? You get to showcase your personality and everything like that. But what I'm talking about here is the common slogan that we hear all the time is marry the house and date the rate. And that could be, nothing could be further from the truth than right now. Right? Because the rate right now is going to be temporary. If you look at the dot plot, you believe in the dot plot, you believe in the Fed and what it's trying to achieve, it's clearly indicating that interest rates are going to be coming down, which is fantastic. Which means that we as professionals need to make this our mantra. I get it's a slogan that people say all the time, but it is something in today's environment that is absolutely critical to be pushing out to our clients so they clearly understand the opportunity that they have right now. So really quick, because our objective here, right, is to always assist in moving homes. So number one, what is the benefit of dating right now? Look, rates are on the decline, which means buying the perfect house today means that your payments for that house are going to be cheaper in the future. So waiting makes virtually no sense because of these other factors as well. The second one is, and for a majority of the markets out there, inventory is high. It is not going to remain at these levels, right? As more buyers now come into the marketplace, given the anticipation of lower rates, and as we move into 2025, inventory is going to shrink, right? You're not going to have as many choices if you're a buyer right now. You're not going to be able to go out there and see 5.5 months plus of inventory. So that is something you definitely need to take into consideration. And once again, one of the reasons why right now, in my opinion, it is the perfect storm to buy a house. The third thing is negotiating, right? Sellers are not going to be in this position for much longer. I predict by the end of Q2 at the latest, this market is going to have shifted. Sellers are no longer going to be willing to negotiate with buyers, and it is going to be multiple offer situations. Once again, you're going to have less inventory to choose from. It is not going to be in your best interest to wait if you're a buyer, is my point. Again, we are in the perfect storm. Marry the home, date the rate. Third thing, home values have bottomed. In my professional opinion, and I think we're seeing that consistently now, we are not going to see a drastic decrease in home values. It's been stabilizing now for several months, and if history teaches us anything, in 9 of the last 11 presidential elections, home values have increased post-election, which means we are a month and a half away, 2 months at most, to where we are going to start seeing home values on the increase, right? And a lot of that's going to be just due to activity. And it's also going to be due to the election is now behind us. Whether you like the candidate or not, you know what you're going to get for the next 4 years. Your confidence level picks up, and therefore you act. The fifth thing is a 15% decline. This coming month coming up, the 1 month prior to a presidential election, sees a 15% decrease in sales. Wow. To me, that is an amazing opportunity if you're a buyer. I mean, if you're listening to this and you have clients or you are a buyer yourself, do not sit on the sidelines come October. I get all the noise. I get the election. I get all the negative ads. But what a unique opportunity for less competition. Houses are going to be out there. The willingness of people to negotiate. I just think it's an amazing opportunity. Take advantage of the month of October to jump full speed into your home buying process. And the last thing I think is very important is, look, the ability right now to use the bank's money. And what do I mean by that is right now, with rates anticipated decrease over the next year and a half that we've seen laid out by the Federal Reserve themselves, there's no better opportunity than if you can afford it to take a slightly higher interest rate, use the bank's money to fund escrows, to fund closing costs, to do things like that in anticipation that you are going to be refinancing that home anyway to a lower potential rate. And at that time, when the market is perceivably bottomed out on an interest rate perspective, that would be the exact time to pay your closing costs, not today. So combine all those factors, it is a great time to date and get out there and get into the market and buy that perfect house. All right, everybody, I hope that was a great dump of information. I hope that helps you in every way possible and your clients. You need anything, flyers, numbers run, numbers crunched, ideas. You want to sit down and have a coffee, how to market, how to gain more market share, whatever it is. I would love to do that. Just give me a ring, give me a text, shoot me an email, and let's get something on the calendar. You all have an amazing, blessed week. Hustle and crush the week. Cheers.